So everyone's always asking me, Matt, in my situation, what type of investing should I do? What type of investments should I be using and why? Well, at this point, it's good to decide, are you a conservative investor? Are you a moderate investor? Or are you an aggressive investor? One of the things I've noticed is over the years, many of the public and also many financial advisors aren't aware of the truly moderate styles of investments. Too often, they'll call what I would refer to as an aggressive investment as being moderate. So let's talk a little bit about this. A conservative investment is an investment where your principal is guaranteed and reinsured. The principal is your original deposit that you put into the investment account, and guaranteed means the investment provider has a cash reserve to back it up. If there should be any problems along the way, it's not your problem, it's your investment provider's problem, and they actually have to take money out of their own corporate pocket to make good on your accounts. Now, reinsured means there's some type of government agency that they have to account themselves to, some type of small fee that they pay to reinsure your accounts. So if the company should fail, it's still not your problem, your account is still safe. Now, also with the conservative accounts, the interest is declared. They tell you ahead of time how much interest you're going to make. So you can predict your account value or your cash flow next week, next month, next year, and beyond. So there's an extremely high level of certainty with these types of accounts. You can probably name a few just off the top of your head. Things like savings bonds, the double E's, CDs, fixed annuities. These are all different types of conservative accounts where your principal is guaranteed and your interest is certain. So any type of account that meets those two criteria, safety of principal and certain interest, I would certainly refer to as a conservative account. Now, another style of investing would be moderate, which I'm going to skip over for just a moment and move on to aggressive. Now, aggressive investments are investments where we don't know how much you'll make, the growth or the interest is uncertain, and your principal is at risk. So you might get back less money than you originally put in. So with an aggressive investment, both your principal and your growth are uncertain. Now, aggressive investments can be individual stocks, it could be an index fund or a mutual fund, or it could be a variable annuity. These are all different examples of aggressive investments. Now, aggressive investments can work really well if you're adding money to your accounts regularly. Every 2 weeks as you get your paycheck or every month, you add money to an account. This helps you because over time, these aggressive accounts don't just go up, they also go down. So when the aggressive account goes down and then you add money to that account, you're buying more shares. You're buying more shares at a cheaper price. So on average, it brings down the cost of what you're paying for your investments. That's why they refer to this as dollar cost averaging. So if you're starting with a small amount of money, but you're adding a regular amount to it every month, this will build your portfolio quicker than a conservative or a moderate account. So aggressive accounts make a lot of sense for younger folks, but once you get within about 5 years of retirement, you want to start thinking about and probably pulling back the risk on your aggressive accounts to something more moderate. Now, the reason why I say this is aggressive accounts just don't go up. We saw a big drop off in year 2000, 2001, and 2002. It was actually a 6.5 year recovery till we got back to our March of 2000 levels. We also saw a pretty acute drop off in 2008, and that was a 5-year recovery for that. Well, one of the golden rules of investing is buy low, sell high. So you don't want to be cashing out or taking income off of an account when it's down. So that's why I say, if you're within 5 years of retirement, you do not want to be risking principal that you're going to need to generate an income off of within the next 5 years. So many folks spend their entire lives flip-flopping between conservative and aggressive and conservative. When greed overcomes fear, they'll get out of the conservative and into the aggressive. And when fear overcomes greed, they'll get out of the aggressive and back into the conservative. The problem with this is they're late leaving the party that they're in, and they're late getting to the other party. The market timing is all wrong. Too often, when folks get out of the conservative and into the aggressive, it's because the stock market has already had a big run-up, and now they're buying at all-time highs. Or when they get out of the market and into the conservative, it's because there's been a large market drop, and now they're getting out of the market at a low point, and they're getting into a conservative interest-bearing account also at a low point. Not a low point in terms of value, but a low point in terms of the interest that's now available to be had. Because over time, conservative accounts will pay more or less. I think many of us remember back in the late 70s, 1979 to be exact, when you could get 15% on a CD. Well, those days are long gone, but you still can get a good amount of interest on a conservative account if you know where to look. So too often people make this jump back and forth and they do it at the wrong time. Where I believe most folks would actually be better served by learning about and using what I refer to as the moderate style of investing. Now, moderate investments are investments that borrow from both the conservative and the aggressive. It borrows from the conservative in that your principal is guaranteed and reinsured. In other words, it's safe. Your growth, however, is uncertain. We don't know how much you'll make, but we do know that you won't lose anything. So when the market goes down, your account stays level, and when the market goes up, you get about 1/2 to 2/3 of the growth of the market. Now keep in mind that if I told you there's investments out there that get all of the growth of the market with none of the risk, that's too good to be true. It just simply doesn't exist. But with the moderate family of investments, the way they have you invested, they're able to get you 1/2 to 2/3 of the growth in the good times when the market goes up, and when the market goes down, you don't lose anything. Your accounts stay level. Now these types of accounts, these moderate types of accounts, are known as equity-linked notes, stock market certificates of deposit, and equity-indexed annuities. They all work the same way in that the only uncertainty you're taking on as the investor is how much you could make, not how much you could lose. So the moderate family of investments makes a lot of sense for folks who are within 5 years of retirement or who are retired in the first half of their retirement, let's say 75 to 80 years of age at the top end. With these types of accounts, you have the opportunity to grow your money faster than inflation, but you still have the guarantee against loss. So not only are they good growers, they're also well suited for producing an income as well. Because remember, you don't want to be pulling income or you don't want to be taking withdrawals off of an account when it's down. So since these moderate accounts don't lose money when the market goes down, they are well suited for producing an income. So just to recap, if you're 75 years or older and the most important thing to you is income and you want to preserve your principal, take the interest off of your conservative accounts and shop around and find the best interest rates you can. Whether it's a savings bond or a CD or a fixed annuity, they're all safe. Go with the highest interest rate. If you're a younger person and you're adding to your accounts every month and you're more than 5 years away from retirement, go aggressive. Ride out the waves. They'll actually be of help to you over time. And if you're within 5 years of retirement, up to 75, 80 years of age, you really want to focus on the moderate family of investments, the equity-linked notes, the stock market certificates of deposit, and the equity-indexed annuities, because they'll allow you to go into retirement with the amount of money you think you should have, as well as being able to grow that money throughout retirement without the worry of a large drop in the stock market wrecking your lifestyle. So I hope you found that helpful. 3 different styles of investing: conservative, moderate, aggressive, and when they might be appropriate to you. So if you'd like to learn more, there's a couple of things you could do. You could follow us on Facebook, you could subscribe to our YouTube channel, or better still, just pick up the phone and give us a call. We'd be happy to talk to you.